Good morning and welcome to the latest Brody's Banking and Finance Academy, with this session focusing on the project finance model and its effective uses and the potential future trends. My name is Ben Powell. I'm a legal director in the banking and finance team at Brody's, based in Edinburgh. I've specialised in project finance for nearly 20 years, but I also work across a broad range of financing transactions covering energy, infrastructure, housing, and leveraged finance. So, moving on to the agenda, I'm joined by my colleagues Thomas Horton, who's an associate in the banking and finance team here. Thomas has recently advised on a large-scale healthcare infrastructure PPP project, and also by Fiona Hunt, who's a solicitor in this same team, and she has recently advised on a number of operational PPP projects. Together, we're going to help you to understand more fully, firstly, the key characteristics and documents of project financing, and how, as a financing technique, it needs to adapt towards a more hybrid model in order to be more fully and effectively utilised in the UK. We're also going to give you some background on our experience of using the project finance model, and perhaps how and when you may wish to consider using it or elements of it in your transactions. Finally, we'll have a look and a discussion on future trends and priorities that may affect the use of project financing as a funding technique. But before we dig into this some more, I'd like to ask you to keep the following question in mind, and perhaps it might inform some questions. So, how do you think project finance can best help address the funding gap that many see as being the key issue facing infrastructure development? I think we need to think, when we're considering that question and considering the use of project finance generally, about the wider economic context and what in that wider economic context project finance actually is. The quotation that's on this slide, the source of which I've not been able to find, sums up the key elements of project financing. It states, project financing is the financing of the development or exploitation of a right, a natural resource, or other asset, where the bulk of the financing is to be provided by way of debt and is to be repaid principally out of revenues generated by the operation of the asset. And this is not a new concept. Project finance has been traced back to the Roman fenus nauticum, sorry for the Latin, or sea loan principle. And under that, ship owners borrowed money to buy goods for trade, and then those loans were repaid from the proceeds of sale of those goods. The development of silver mines in 12th century Devon, the construction of the Suez Canal in the 19th century, and the 1970s boom in North Sea oil and gas all used elements of project financing. And what all of these projects, it might seem funny to call Roman shipping projects, but let's do so. What those projects have in common are all the elements that this quotation references. These are projects that, firstly, they're capitally intensive to develop and have significant levels of variety of risk that need to be mitigated both in their development and operational phases. They're projects that require long-term financing. They're projects whose development costs can only be repaid through the revenues generated by the project they have developed, and therefore can only provide security over the project assets. It's for this reason that they're known as non-recourse or sometimes limited recourse financing. Finally, these are projects that require lenders to have some ability to step into the shoes of the project, to keep it running, and to thereby preserve the project income streams. More recently, and perhaps most well known, the development of PFI, PPP, and other similar models all used project financing techniques across a huge range of sectors, including education, healthcare, transport, housing, defence, and technology. Those same techniques have been most extensively developed in the energy sector, both renewable and conventional, and it is in those areas that the main action is seen in project financings today. So within that wider economic context and from an economic perspective, project financings have some distinct risks or drivers. And in the current macroeconomic climate, some of those risks and drivers are up on the screen there for you. Firstly, development costs. And by that, we mean not only development costs of individual projects, but particularly in the energy sector, the aggregate cost of transition from a carbon economy to a green economy. Who's best placed to meet those upfront costs? You also need to consider technology and risk development. How can such long-term projects be future-proofed and, where needed, adaptable to future technologies? Looking at borrowing costs, PPP and PFI benefited from an era of relatively cheap debt. How can developers afford to borrow and projects afford to service debt at a time of rising interest rates? Looking at the current inflation situation, it's not as bad as it was, but with high development costs, we've also seen the impact of particularly high construction inflation. This impacts projects and procurement, squeezes margins and for developers and constructors. And how can that risk of inflation be managed? You need to think about public finances, particularly in the case of traditional social infrastructure projects. How can the public sector afford the development of new projects and the operation of existing facilities when public finances face continued downward pressure? You need to consider developer return, what's appropriate given public sector involvement, and how can this be controlled alongside the incentivization that return provides? And finally, you can't get away from political risk. Project financings typically involve a public sector entity, and how can political change and volatility, Brexit, war, independence, coup d'etat be managed within a project financing? So all of that is a little esoteric. How do they work in practice? I'm going to hand over now to Thomas and Fiona, and they'll look at how project financings are structured and how they have used these structures and how those structures can find a home for or mitigate these sorts of risks. Thomas.
Yeah, thanks very much, Ben. So I think, as you say, quite a complex sphere to be operating in. And so what I thought I might do quickly before moving on is just really quickly touch on a banking lawyer's role in a project finance transaction. And a large part of that role really is around project management. So this is because, for the most part, the overarching facility or loan documentation or common terms agreement is where the conditions precedent, the CPs for the transaction are located. And so a banking lawyer has to have a really keen eye on the wider aspects of the deal to ensure the smooth flow of CPs. And that's something that I'll let Fiona touch on a little bit later on. But taking a bit of a step back, I think it's been said that while the model, the project finance model, has a lot of the same features as a general corporate finance deal, project finance deals are much more highly structured, they're much more multi-phase, and that means that there are a number of specific concepts throughout those deals. And the structure of a PF deal can actually get quite complex, and so I think that then leads to the CP element being a really important one to keep track of. So just on the next slide, I appreciate there's an awful lot of information there, but what that is it's just a template program for project financing, where down the left-hand side you have project tests or event milestones, things that need to be done basically to complete a project finance transaction. And along the top there, a scale and number of weeks as to when you might expect that task to be completed during the lifetime of a project finance deal. And really the reason for putting that program up on the screen is just to show you the sheer length of time it can sometimes take and the number of steps that need to be completed. So sponsors approving the project and feasibility studies being carried out in weeks 1 to 4, but then the first drawdown might not be until a year later, 52 weeks later, and I think that just shows you how complex some of these project finance deals can be, really. So then on the next slide, I thought I would just give you a bit of a background on some of the parties to a project finance deal. And so the starting point for any project finance transaction is very often the incorporation of a special purpose vehicle, or SPV. And they're very often the borrower for the purposes of the transaction. The SPV is then used to hold all rights and assets to the project, and that are deemed required for the building and running of the project. And it's very often the case that the borrower won't have any other assets other than those which relate directly to the project. And the majority of rights or assets held tend to be contractual or potentially property rights in relation to the site of the project itself. So then once the entity structure is agreed, the financing structure is decided, and it's largely understood that the majority of finance in a project finance deal tends to be in the form of a majority of bank debt from either one funder or more often than not syndicate funders. with a smaller element of equity investment coming from a sponsor. So on the slide there, I've got under the funders heading a few roles of different funders, different banks in a project finance transaction. I just wanted to really briefly canter through them before we moved on. So facility agent, the first one there, in a syndicated loan, so that's where a number of funders are involved. One of the funders will take on the role of the facility agent for the purposes of administering the loan on behalf of the syndicate. And this role actually tends to take on an even greater significance in project financings, as inevitably there's more admin matters that need to be undertaken. I'll refer you back to the previous slide there about the project finance program. Next, we've got the account bank, which is the funder of the bank through which all of the cash flows flow. So there'll usually be a number of accounts held at this bank, things like a disbursement account where any disbursements in relation to the project might be deposited, but then also critically, more often than not, a debt service reserve account, which is something I'll come back to a little bit later on. And the final role there for funders being hedging banks. And these are funders that will offer interest rate hedging, which put simply allows the borrower to borrow amounts at a floating rate of interest in their loan facility, and then enter into an interest rate swaps hedge to hedge against their exposure to a risk of a rise in interest rate. And the final heading we've got there on the slide is sponsor. So that's the equity element that I mentioned, and very often they are the ultimate beneficial owner of the SPV, and they are quite often a large financial fund or institutional investor, or an entity that has experience in the relevant field, so like a large building contractor, an energy company, or a healthcare entity. And quite often, as Ben touched on in his introduction, there might be that public-private element, where the project might be operated for a public sector body under a project agreement. So I mentioned that split, and having that sponsor-funder split allows the risk to be split between the sponsor and the funder, but it also means that in the case of smaller companies, smaller SPVs, where balance sheets might not be quite as strong, it gives that company, the borrower of the SPV, the ability to raise necessary finance to invest in the project on their own. And it's quite often the only way in which they might be able to raise the necessary funds in order to carry out the transaction. And I think it goes without saying that generally, the more risk that lenders or sponsors are expected to assume in connection with the project, the greater the rewards in terms of things like interest or fees that are payable. So on the next slide, I thought I might touch on a few key ways in which funders and sponsors might try and mitigate their risk. And a key way they might do that is to include either a debt service reserve mechanic or facility in the loan documentation, or have a debt service reserve account. And the latter there involves setting up a sole account whose sole purpose is to set aside debt payments in the event of a disruption to cash flows, to the extent that the debt can't be serviced. So I touched really quickly on the risk between funders and sponsors, and what the DSRA is really looking to do is to put an element of risk of non-repayment in the SPV's hands. So because what we're trying to do when assigning risk really is to assign the risk to the party that's best able to address it. And obviously SPV is best able to address the risk of non-payment. Quite often the DSRA would have a big lump sum, so sometimes 12 months worth of debt service, but the requirements will be set out in facility documentation. But the needs of the DSRA will change over time quite often, where initially, as I say, a funder might say they need 12 months debt service in the account, and that might be for the first few years of the project. And then after that, after a period of time where cash flows might stabilize, the DSRA target might decrease. And simply speaking, the DSRA is a safety mechanic that gives the borrower time to deal with a lack of cash flow, lack of cash flow available to them to service debt, and quite often it prevents them from defaulting. And the funding of the DSRA is often funded from a mix of funder debt and equity. So what's required there is a forecast of debt repayments over the set period of time, and then ensuring that the amount, that relevant amount, is deposited into the debt service reserve account. And then if debt payments increase or decrease over time, then the funds in the relevant account, the debt service reserve account, can increase and decrease. But the funding of the DSRA can actually get quite complex, to be frank, because if you use purely debt to fund the DSRA, then you're only increasing the amount that needs to be deposited in the DSRA. And as you can see, it can get quite complex and circular. And so I think it's really key to flag here that borrowers ensure the calculation of the amount to be deposited is left to financial modelers, something which Fiona will touch on, and not left in the hands of the borrower themselves or their lawyers for that matter. What's also key for funders to mitigate risk, and key for borrowers alike really, is that there's an effective security package as well. And this would often take the form of floating security, fixed security over any land assets, fixed security over shares in the SPV potentially, assignations in security of key contracts, and direct agreements. And what that full package of security would allow is for funders to take control of the project in the event that the SPV defaults or they don't repay their loan. And given direct agreements, I think, are likely to be a bit more of an alien concept to some of you on the call, I thought it might be worthwhile on the next slide to spend a bit of time going over exactly what a direct agreement is actually. So a direct agreement is a tripartite agreement between the project company, SPV, the security agent or trustee on behalf of the syndicate funders quite often, and the contractual counterparty under the relevant project agreement, which is subject to the direct agreement. And as I mentioned, direct agreements will often supplement the security granted by the project company, and direct agreements tend to be in relation to hard to replace long-term project agreements that are fundamental to the operation of the project. So on the slide there, on the pebbles there, I've got a few examples of where you might of contracts which direct agreements might apply to. So things like an important revenue generating or offtake contract, so a power purchase agreement, something like a material construction contract, like an important equipment supply contract. Potentially could cover something like an operation and maintenance contract or engineering, procurement and construction contracts. So why would a funder insist on there being direct agreements in place? Well, put simply, the direct agreements provides a mechanic to maintain the framework of the underlying security. They also enable funders to take control of a faltering project. And thirdly, if funders do ultimately enforce their security, direct agreements provide a means of transferring the key project agreements to a replacement obligor. And they grant funders various rights under the key project agreements so that the funders can maintain the status quo while attempting to resolve any problems that the project might have. So that links into, I think, the point that Ben was mentioning earlier on of more often than not, the main recourse to funders where an SPV does default is really in relation to the cash flow generated by the projects. That links into the direct agreements, and the recourse is to the cash flow rather than specific assets. So that leads back to our non-recourse or limited recourse principle. And I should say here that other recourse could include the right to rescind the loan agreement, the facility agreement, so demand repayment of the loan, and or claim damages for breaches of undertakings, representations, and warranties. So as we mentioned earlier on, the structure can be quite complex and quite and the documentation quite involved, and this really feeds through to the finance and the transaction documents. And so what I've got up on here on the slide actually is a structure chart for the transaction that Ben mentioned, and it shows a recent transaction where Brody's were involved for the funders in relation to the construction of 7 community nursing units. And here, this was a really good example, I think, of where private investment in the form of bank debt and equity amounts were used to deliver a public sector infrastructure project, which was then paid off by the public sector body. And I think what the slide here shows is one, I think the number of parties involved. So obviously you've got all your funders there in kind of pinky purple on the right hand side, various investors, holdcos, SPVs, contractors, and on the left hand side the health service executive. But then also in the smaller font there, just the sheer volume of some of the documentation involved. And I think that leads really nicely onto the importance of the CP element, which I'll hand over to Fiona to tell you a bit more about.
Thanks, Thomas. So picking up on what you've said already about conditions precedent, I'm going to run through in a bit more detail what they are, why they're important, and what they generally cover in a project finance transaction. So as already mentioned, in the context of any facility agreement, conditions precedent, or CPs as they're known, are conditions which must be satisfied before a borrower can utilise and draw a loan. Due to the complex nature of project finance transactions specifically, which was shown perfectly on the last slide, there can often be a huge number of CPs to gather. The CPs are gathered by way of CP checklist, which is a live document that's used to monitor the progress of the transaction, and it's usually the lender's lawyers that prepare the checklist, and as the borrower or their agents produce the CP documents, the checklist is updated and recirculated to the parties. And this ensures that everyone is aware of the status of the CPs, and the lender's lawyers can collect, review, and approve the documents as they come in. So moving on to the purpose of CPs. The CPs are included in the finance documents to benefit the lenders and to provide them with information about the borrower and the project itself. This is so that they can be satisfied on the key issues that their credit appraisal has been based on before releasing funds to the borrower. When in a transaction are the CPs required? Well, a standard project finance transaction will have multiple drawdowns with CPs that need to be satisfied at the first drawdown and then at subsequent periodic drawdowns. So looking first at what's required for the first drawdown, the CPs required for the first drawdown are also in practice usually the same CPs required for signing, given the two tend to happen simultaneously. The CPs required for the initial drawdown are usually listed in a schedule to the facility agreement or the common terms agreement and are largely documentary in nature. At this initial drawdown stage, the CPs are designed to satisfy the lender that the borrower is authorised to borrow the loan amount and to enter into the contracts relative to the project, that the security arrangements in place are sufficient and effective, that the project complies with all applicable laws and governmental permits, which can be particularly important in the energy sector, and ultimately to ensure that the lenders are satisfied with the terms and enforceability of all the material documents relating to the project. So what is required in practice? In addition to the standard documentary CPs that you'd see in any other loan transaction, a typical project finance facility agreement or common terms agreement will contain CPs relating to a number of project finance specific requirements. And these are up on the slide now, so I'll just run through them. The first relates to the project documents. Given the project documents are critical to the success or indeed failure of the project, the lenders will want to see agreed forms or certified true copies of the project documents and evidence that the project documents are in full force and effect, or at least that they will be at the time of financial close. Moving on to the security package, as with any secured lending transaction, the lenders want to be assured of the comprehensiveness and effectiveness of the security package in place. However, in relation to a project finance transaction, it's particularly important for lenders to see copies of all signed notices required under the security granted in respect of the project documents, the insurance contracts, and the project bank accounts. Next up is authorizations. Given the nature of project finance transactions, the majority of projects will require a range of permits and licenses for the construction and operation of the project. An obvious example of this would be planning permission for the land that the project is going to be built on. Lenders will therefore wish to see that these permits are in full force and effect or if they have not yet been obtained, that they'll be granted within a specified time frame. Moving on to due diligence reports. Due diligence is obviously an important part of any finance transaction, and project finance deals are, of course, no exception. An important part of the due diligence process in project finance specifically, though, is the preparation of a feasibility study to determine whether or not the project is viable in the first place. And you'll have seen this on Thomas's timeline slide as the very first milestone to be met. So the lender's technical advisor will approve the technical aspects of the project and produce a report for the lender's approval. Other advisors may also be engaged to investigate other aspects of the project, such as carrying out legal and environmental due diligence. The CPs will therefore include conditions that the lender has received copies of these reports and are happy with what they contain. Moving on to insurance, as Thomas mentioned, a huge part of project finance is about managing risk. Project finance deals involve construction risks as well as operational and political risks, and this is particularly so in the oil and gas sector. So in order to mitigate these risks, the lenders will require the borrower to have various types of insurance in place. This translates to the CP checklist as a requirement for the borrower to produce evidence confirming that all the insurances required under the facility agreement or the common terms agreement are in place and that the terms and the level of cover are satisfactory. This requirement is normally in the form of an insurance broker's letter of undertaking from the borrower's insurer, and it's important to be aware that negotiating the specific terms of this letter can take quite a substantial amount of time, so it should be a process that's started as soon as possible to avoid holding up completion. Now looking at the financial model, as we all know, the cash flow generated by the project is what is used to repay the debt. And as Thomas mentioned, given the non-recourse or limited recourse nature of project finance deals, the lenders want to be confident that the project is going to make money and enough of it. The financial model is a spreadsheet which details the forecasted revenues and outgoings of the project, and lenders will typically engage an expert model auditor to review the financial model and then report back to them on the accuracy of the information included. So this report from the auditor confirming that the project is indeed expected to generate sufficient sums to repay the loan will be required by the lenders as a CP. And finally, the project accounts. It will normally be a requirement under the finance documents for the borrower to set up project bank accounts for use throughout the term of the project, as this just makes it much easier to monitor cash flow. As a CP, the lender will therefore require the borrower to provide evidence that these accounts have been opened and that they're ready for use. So this is just a snapshot of what can be required under the CP checklist. And as you can see, there's a huge amount of documentation and information to be gathered before the transaction can close and the first sum is drawn down. So a key takeaway from this section is therefore just how important it is for all parties to be aware of the documents they're responsible for and really to get the ball rolling as early as possible when producing these to avoid any delay to completion. Now moving on to subsequent drawdowns. A project finance facility is usually drawn down throughout the construction phase of the project to allow the borrower to meet certain costs as they come up. The CPs for further drawdowns are again normally contained within the facility agreement or the CTA, but this time tend to be more factual in nature. At this stage, they're designed to give the lenders justification to withdraw funding if the project is in distress, to ensure that the borrower is continuing to comply with the funding terms set out in the facility agreement, to ensure that the project is progressing as planned and that the agreed construction milestones are being met, both in terms of timing and budget, and to provide confirmation to the lenders that no other material adverse events have affected the project or the borrower since the last drawdown. So at each drawdown, there will usually be a CP regarding eligible costs. So the lender will ask to see details of the costs that the drawdown sum is going to be used to meet. There will be another regarding compliance with budget. So the lenders will require evidence that the costs incurred by the borrower don't exceed the amount budgeted in the construction budget. There will also be a CP regarding cost to complete. So this will be evidence that the borrower has sufficient funds to complete the project on budget, on time, and in accordance with the agreed specifications. And finally, confirmation from the lender's technical advisor that all this evidence provided by the borrower is satisfactory. And finally, to round off the discussion on CPs, what happens when a borrower wishes to utilize the loan, but the CPs have not all been satisfied? Well, lenders can, of course, opt to waive conditions precedent, but should consider a number of factors, and these are up on the slide now. Lenders will also need to decide whether to waive the CP permanently or convert the CP to a condition subsequent. So that was a whistle-stop tour of conditions precedent, and I'll now pass you back over to Ben, who's going to cover future trends in project finance.
Thanks very much, Fiona, and thanks, Thomas. Effective uses of the project finance model depend, as you've both very clearly set out, on managing a vast amount of paper to begin with. But thank you. I think that was really helpful. I really like the slide of the Irish deal, and perhaps we'll come on to that a little bit more, Thomas. It's a wide-ranging and time-consuming process managing a project finance transaction, and bearing in mind that complex structure, is project financing something that can accommodate any hybrid financing models or tools, and what would need to change in order to do so? I think to consider that a bit more, you need to understand, what does hybrid financing mean? And I think it can mean many different things, depending upon the sector you work in and the funding that you look to put in place. The answer to what exactly hybrid financing is and entails will be very different. Perhaps at its most basic, hybrid financing implies striking a balance, I think, between medium-term bank debt and long-term either bank or bond finance. And that, at first blush, might look incompatible with traditional project financings, which, as Thomas has said, have typically been funded with just long-term bank or bond debt and only a small sliver of subordinated debt making up the balance. PPP projects regularly saw the debt-equity ratio rising to around 92:8, with the bulk of the equity made up of subordinated debt and true equity being pinpoint only. In renewable energy project financings, this ratio is more commonly around the 80-20 or 75-25 mark, reflecting the risk profile of those projects. So really, hybrid project financing looks not only to skew this ratio, but also to skew the traditional debt tenors that apply to the different tranches of debt being put in place. And I think it really is changed to tenor that is one of the main development areas for any hybridization of project finance. By that, for example, I mean long-term debt, typically which would amortize over the lifetime of a project, or bond financing may continue to be used, but alongside a mini-perm tranche of debt. That's debt with a tenor less than that of the project lifetime, less than that of the senior debt. That will require modeling of capital payments, among other issues, which we'll come on to in a minute, and to ensure that the capital repayments of both tranches are affordable within the project cash flows. These structures, though, have been made to work on renewable energy projects in particular. In the infrastructure project sector, the use of project bonds has rebounded somewhat. So these would involve the issue or placement, private or public, of long-term bonds at financial close of a project to fund its development phase. Fixed repayments of capital and interest are then typically made under the bonds throughout the majority of the lifetime of the project. Bond financing is not new, obviously, and particularly pre-credit crunch was routinely used for larger scale infrastructure projects. The benchmark for considering bond financing in any project typically then was around about £100 million, and that was seen as being the starting point for considering bond financing due to the higher cost of setup of a bond financing when compared to a bank senior debt financing. However, the inability of monoline insurers to underwrite bonds post-credit crunch really did hurt the market. It made it very difficult to secure sufficient ratings for the bonds to attract institutional investors to invest in them. But that is now changing. And in fact, here in Scotland, the Scottish Government announced at the end of 2023 that it intends to issue sub-sovereign Scottish bonds, gilts, which are inevitably being called kilts already, and that they'll be issued before the next election in Scotland. We understand that work on these, scoping work on those is ongoing. It'd be fascinating to see, I think, how much can be raised within the Scottish Government's borrowing rules. Also, what the appetite for such bonds will be in the institutional investor market, and critically, where the bonds will be deployed, or the funds raised under them, I should say. They are stated to be specifically targeted to fund infrastructure projects. Now, it may be that funding under such bonds may come into projects alongside long-term debt funding, or it could come in as standalone funding. Either, I think, is possible and largely depends on how much there is that can be raised under them. I think a further hybridization, again in the bond market, relates to the potential for securitization of packages of bond finance projects. That's been particularly seen already in the renewable energy and green bond sector, so it's an area for growth still. And if we are talking about hybridization, what other tools, funding tools, can be considered? There are many, and I will, in the time available today, just briefly highlight a few of them. You could look at using, alongside debt, national or supranational central funds. Now, typically in the UK, this did mean the availability of EU grants to sit alongside debt funding, though of course these are no longer available. Another option would be to look at central or investment or development bank funding, again, sitting alongside other debt funding. In the UK, and again up until Brexit, the European Investment Bank participated in funding of a number of projects, and it continues obviously to do so within the EU. The UK has established the UK Investment Bank post-Brexit to plug this gap, and its involvement in a variety of projects is being carefully watched. Similarly, in Scotland, we've had the establishment of the Scottish National Investment Bank, which is active in funding in a number of areas. So I think you could also look at the type of project you've got and consider whether the role of natural capital may have a part to play. I'd have to say this is a somewhat more of an emerging trend, although I know that the UK Investment Bank has funded a natural capital project already. I think at the moment, actual project opportunities are not perhaps as easily identified as in other traditional infrastructure sectors. There's a few other options you might look to put into your hybrid project financing model. Can you attract pension fund investment? It's obviously some synergies which have been talked about for a long time between the long-term returns required by pension funds and the long-term nature of most infrastructure projects. Could you look at using trade credit insurance, particularly in a project where there may be a large variety of kit or equipment that's required in it? Could you spread the risk that way? Could you look at using guarantees? I mean, they're already used, obviously, in terms of parent company guarantees of, for example, construction liabilities. But could you look at public sector guarantee to take a slice of the risk of the project? And where would that sit? And what would that do to the other financing requirements? Could you look at other credit enhancement products, for example, letters of credit or bonds? Again, already used largely in things like the construction sector to back some of that risk, but is there potential for developing those products within the project financing structure? You might also, if you're looking at a multinational project, consider the involvement of the export credit agencies. Is there some risk there that could be taken by them, and what does that do for the cost of the project? So I think really, in essence, if you do hybridize any project finance model, the factors that you're going to have to look at are probably pretty self-explanatory, but I'll run through the ones that occur to me. You're going to have to look at the priorities of those various tranches of debt and products. You're going to have to look at security for them and how they rank. You're going to have to look at enforcement controls on their securities. Who controls the enforcement at any one time in the project? And does that need to change as the project develops and progresses through its lifetime? You're going to have to look at how distributions are treated within the cash cascade and more generally. can that be accommodated within the actual requirements of a multi-layered project financing? You're going to really have to understand the different risks at the different project stages. You're going to have to balance and price those risks, and you're going to have to consider that impact on the margin of all tranches of a hybrid project financing. You're going to have to consider, I think, alongside that, whether that allows you the ability to refinance the project and build in that refinancing at the outset. I think another area to look at is the role of hedging and its applicability to all debt tranches or not. And finally, you're going to have to look at the political climate and what is allowed at any one time. So in the time available today, I think it's only possible to offer us that snapshot of the potential for hybridization. I was thinking about this, Thomas, and obviously, I think from our side of things, the CNU deal that you put up on the slide contained elements of hybridization with EIB's involvement, and I wondered how challenging was it balancing in that layer of debt there?
I think in a word, very. So I think given as you mentioned, we had that supranational central element with EIB being involved. That really added, I think, a layer of complexity that you might not see on less high profile deals. And I think really the big added complexity was trying to balance three different funders' views on things. So on the aspects you mentioned there, on things like priority of debt, on enforcement controls, and really I think given the EU element and the fact that the EIB money was EU money, so to speak. EIB were quite firm in their position on quite a lot of things, on things like the priorities of debt and enforcement, and ultimately, I think what that led to was some concessions from EIB on some aspects, some concessions from other funders on other different aspects, such that I think really what happened was, in the end, each of the funders carried the day, so to speak, on one point or another. But I think at that really high level, that was quite difficult. But then you didn't even think of until it came to pass about things like different drawdown mechanics or different reporting specifications or frameworks that the different funders might have. And so, to be honest, I think that's really where Fiona's piece is probably a really, really important one of in those scenarios where there's different drawdown mechanics, different reporting requirements, you really need to be on top of the CP management element.
Yeah. I think that's sometimes borrowers might look on that almost as a lowest common denominator position, where you've got competing demands and they don't want to end up with the harshest possible position, because that's taking all of those views into consideration, that the hardest one has to win the day, and that can be a difficult balancing act even within a syndicated structure. But you're really adding in a level of complexity there. Yeah, thank you.
And I think, Ben, just maybe a quick one for you then, actually. Bearing in mind the background then and the other potential funding options, what or where do you see as being the real areas for project finance expansion?
What did you say when I asked you? It is. I asked you how difficult it was, and you said very, and you asked you how many, and I'll say lots. Where are the main areas for development? Lots. In the 1 minute or less than that we have left, I think the opportunities are as wide as the types of project that can be financed. I think it's possible to make a valid argument for a return to the PPP model, given a couple of things like the lack of infrastructure investment in the UK as a whole, particularly south of the border in recent years, and given constraints on public finances. But that's a slow political tanker to turn, to mix my metaphors, and it does require political will and a settled model, and I'm not sure that we're there with both of those yet. I think project finance is obviously playing a massive role in clean energy, and the scale of the transition to a non-carbon economy is so vast that it has to continue playing a role in that. A lot of the technologies are well proven, the risks are well understood, the costs have come down, and those projects are attractive to funders and investors. And the obvious answer would be to do more of them on that model. There are market constraints in there that are well understood: grid connections, planning restrictions, the CFD regime reductions. But I don't think if those risks are understood and can be mitigated, then that doesn't mean we shouldn't carry on using the project finance model. I think, you know, it would be wrong to say that you can't use project financing for oil and gas exploration. You can. There have been new exploration licenses granted, and that suggests there's a role continued to be played, particularly when you consider energy security in the wake of the Ukrainian war, which suggests there's a continued role for project financing there. I think on the whole, I'd say that, you know, there's obviously capital there to be invested in the right projects, and I'd really be happier, obviously professionally, to see a wider remit for project financing, embracing all of the above sectors. The models are proven. They are adaptable. It's not easy within any structured financing, but they are adaptable. We understand them. And I think they've got much to offer to deliver some much needed infrastructure. I think, looking at the time, we've actually run over, and we've had a huge subject to cover in the time available. And we're very happy to engage with anybody who's come along today with you more fully. If you'd like to get in touch, I'm sorry that we're out of time to take any questions now, but I'd like to thank you all very much for attending. I'd like to thank both Thomas and Fiona for really explaining very clearly how we use that model, that complex structured model, and to thank you for your insights. And thanks again for attending.